Block Inc. is currently trading at $63.86. That is a brutal drop of $7.07, slashing 9.97% off its value just today. This isn't just a minor pullback, this is a full-on sentiment collapse. And the immediate reaction most people have is to look for a specific headline, a single piece of bad news. But the reality is, this 10% haircut is the physical manifestation of a much deeper problem that's been building under the surface for months. The expectation that high-growth tech, especially FinTech, could defy gravity in a high-interest rate environment is visibly fracturing. For years, the story around Block, formerly Square, was simple and powerful. You had the Square seller ecosystem, the elegant white card readers that empowered small businesses, and then you had the explosive growth of Cash App. Cash App became the digital wallet for a new generation, a one-stop shop for peer-to-peer payments, stock buying, and even getting into Robinhood crypto territory, and of course, Bitcoin. The narrative was that Block was building two distinct, massive ecosystems that would eventually merge into an unstoppable financial services giant. Investors looked at its growth trajectory and saw parallels to the early days of Apple stock or the platform dominance of Nvidia stock in its respective field. The expectation was clear. This company was the future, and any dip was a buying opportunity. This was the story sold on many investing sites and championed by those engaged in self-investing. But today's 10% plunge tells us reality is hitting hard. The problem with that narrative is that it relied on cheap capital and a booming consumer. Today, we have neither. The reality is that Block's growth is decelerating. The network effects of Cash App are being tested as competitors from traditional banks to other platforms like SoFi, through SoFi Invest, and even payment features built into operating systems are chipping away at its dominance. Furthermore, its heavy exposure to Bitcoin, once seen as a brilliant strategic asset, has become an anchor of volatility. When Bitcoin stumbles, Block doesn't just stumble, it tumbles. This isn't a growth story today, it's a show-me story, and the market is saying, you haven't shown us enough. Let's look at the mechanics of this 10% drop. The volume is massive. We're seeing huge blocks traded, which tells me this isn't just retail investors on their Fidelity mobile app or Robinhood app annex-selling. This is institutional capital heading for the exits. When you see selling this heavy, it's often a sign of margin calls or a major fund liquidating a position. This isn't a few people getting scared. This is a portfolio manager at a major fund deciding the risk-reward ratio has fundamentally broken. They are not waiting for the next quarter. They are selling now, and they are willing to accept a 10% loss on the day just to get out. That tells you their conviction is completely gone. This is a different kind of selling than what you see on retail-heavy platforms. While someone on the Robinhood app might be selling to cover a loss or getting stopped out of Robinhood fractional shares, the volume we're seeing today suggests a systematic de-risking. It's a calculated decision. This is why online investing can be so difficult. The self-investing individual is often trading against algorithms and massive funds that have different priorities. This kind of price action creates a feedback loop. The drop triggers stop losses, which creates more selling, which pushes the price lower, triggering more stops. It's a cascade, and Block is caught in the middle of it. You cannot analyze Block in a vacuum. This move is happening against a backdrop of stubborn inflation and the Federal Reserve signaling higher for longer. What does that mean for Block? It means its small business clients, the Square side, are getting squeezed. Their costs are up, consumer spending is down, and the risk of default is rising. For the Cash App side, the consumer who was flush with stimulus checks is now struggling with credit card debt. The unbanked or underbanked demographic that Cash App served so well is the first to feel the pain of a slowing economy. This is the person who used their Cash App card for everything. Now they're balancing rent and groceries, and discretionary spending is gone. That means fewer transactions, smaller balances, and a higher likelihood of pulling back from auxiliary services like buying SoFi stocks or Bitcoin. The entire value proposition was built on engagement, and that engagement is now under direct threat from basic economic necessity. This is a reality that platforms focusing on more established clients, like Fidelity Brokerage or those with high net worth clients at Fidelity Wealth Management, don't face in the same way. Their clients are worried about preserving wealth, not just getting by. This sell-off is likely a delayed reaction or a reevaluation of their last earnings call. While they may have beaten headline numbers, the forward-looking guidance was likely the culprit. Analysts are probably coming through the balance sheet right now, looking at their goodwill, their debt load, and the cost of capital. Remember, Block made a huge acquisition of Afterpay, a buy now, pay later service, at the absolute peak of the market. That acquisition now looks incredibly expensive, and the BNPL sector itself is under immense pressure as default rates start to creep up. This is where the rubber meets the road. The synergies promised from that deal are failing to materialize fast enough to justify the price tag in this economic climate. Many investors looking for investment help or using investing sites are often drawn to names like Block because of the brand recognition. They might be using a simple platform and just buying what they know. But professional traders on platforms like Interactive Brokers are looking at the technicals, and the chart for Block has been broken for a while. It's been in a clear downtrend, making lower lows and lower highs. Today's 10% drop isn't just a blip, it's a confirmation of that trend. For any trader using a sophisticated SoFi trading platform or the tools at Interactive Brokers, this chart is a sea of red flags. The 50-day moving average crossed below the 200-day moving average a while back, the classic death cross. Today's move cements that bearish setup. You will not find investment help from any reputable technician who looks at this chart and says buy. They will say avoid or wait for a clear bottom, and this is not a bottom. This is a capitulation. We're seeing this across the board in speculative tech. It's not just Block. Look at other high beta names. The market is rewarding profitability, not just growth at all costs. A company like Tesla stock gets a pass because of its tangible margins, for now. But a software-based fintech like Block is being re-rated, and it's being re-rated lower. When you manage your own individual brokerage account, whether it's at Fidelity or Charles Schwab, you have to make these decisions. Do you hold on? Do you average down? Or do you accept the reality that the thesis has changed? Many people using Schwab Intelligent Portfolios or other intelligent portfolio services are likely being sold out of positions like this automatically based on risk parameters. This automated selling from SoFi Robo-Advisor type products and other quant funds adds to the pressure. It's not emotional, it's algorithmic. They're not looking at the long-term story, they're looking at volatility and correlation, and Block is failing those tests today. Your online investment strategy has to account for this. This is why many prefer the diversification of Fidelity ETFs or Fidelity mutual funds rather than holding single high-risk names. The tools available, from the Fidelity trading platform to the deep analytics at Interactive Brokers, all show a clear trend. Momentum is aggressively negative. And let's talk about those fees. The Interactive Brokers fees might be low for active traders, but for the average person, the simplicity of an intelligent portfolio at Schwab or a SoFi Robo-Advisor is appealing. But these services are designed to manage risk. When a stock like Block becomes this volatile, it gets flagged. It exceeds the risk tolerance of the model. So Schwab Intelligent Portfolios will automatically reduce exposure. SoFi Invest models will do the same. This creates a consistent, non-discretionary selling pressure that has nothing to do with Jack Dorsey's vision and everything to do with risk management algorithms. This is the new market reality that many investing sites don't fully explain. It's not just humans against humans, it's humans against machines, and the machines are programmed to sell weakness. So what does Block actually do? It's crucial to understand the two main pillars. First, there's the seller business. This is the original Square. They provide hardware, the white readers, registers, terminals, and more importantly, the software for businesses to process payments, manage inventory, payroll, and even get loans. They take a small percentage of every transaction. This is a solid, sticky business, but it's directly tied to the health of small businesses and consumer spending. Second, there's the Cash App business. This is the consumer-facing app. It started as a simple way to send payments to friends, but it's expanded dramatically. You can now get a debit card, direct deposit your paycheck, buy fractional shares of Apple stock, competing with Robinhood on Robinhood stock trading, and buy and sell Bitcoin. They make fees on transactions, instant deposits, and spreads on Bitcoin and stock trades through Robinhood investment-style offerings. The expectation was that these two ecosystems would feed each other. A Cash App user pays at a Square merchant, or a Square merchant banks with Cash App. The reality is that this synergy has been slow to build, and they often feel like two separate companies.